Welcome to IAS Project. We are continuing with the videos on Indian economy for UPSC Civil Services exam. In the previous videos, we have seen definitions of economics and economy. Also, we have seen types of economics and economy. Now, let's continue further. The question is, can economy be measured? The size of the economy of a country can be measured. Yes. How do we measure it? We measure it using the measurements of national income. What is national income? National income of a country can be defined in multiple ways. One of the ways is related to the total income. So let's see this definition of national income. National income of a country is total income generated by the residents of a country, and those residents of a country living in economic territory for a particular period of time. This is the most generic definition. Now let's see each term here. Total income means the total income that is earned by all factors of production. Also, it can include taxes which are earned by the government and income which goes to the foreign individuals. Residents is a term used in economy for those people and those companies which are operating a business or operating in economic activities in an area or in an economic area for at least one period of time and are involved significantly in those economic activities. So, foreign individuals or foreign companies who are residing in India for at least 1 year and also involved in economic activities here are considered as residents of India, although they are not citizens of India. So the residents here does not mean citizens. Economic territory or economic area can mean the country itself, its airspaces, its territorial waters, as well as those areas which are lying outside country. However, they have jurisdiction of the country itself. For example, consulates and embassies in other countries are also considered economic territory of the country. For example, Indian consulate in USA is considered as economic territory of India, although it is not present within the geographical territory of India. And the last term is particular period of time. Particular period of time usually is for 1 year, and 1 year is usually a financial year. In the case of India, from April 1st to March 31st of next year is called as financial year, and national income is usually measured for this financial year. Now we have seen the national income definition using total income. National income can also be defined using total value of goods and services. Let's see this definition. National income of a country is the total value of goods and services produced in a nation in a particular period of time. Again, particular period of time refers to 1 year or one financial year. A country's national income can be measured as per various definitions. Some of the measures are like this: GDP, NDP, GNP, NNP, national income, etc. We will see these definitions in this video and also in the coming videos. In the case of India, it is Central Statistical Office that computes the national income. Central Statistical Office comes under the Ministry of Statistics, Planning and Implementation. So now we have learned that national income can be measured. What is the purpose of measuring national income? The first point is that it gives idea about nation's available resources and output. The nation's available resources means all those inputs, for example, factors of production, are covered under the resources part. Output, the value of goods and services. So national income gives us idea of two aspects, that is inputs of the economy, that are factors of production, as well as outputs of the economy, that is value of goods and services and the type of goods and services that are being produced. It also helps government in framing monetary as well as fiscal policies. Monetary policies like what should be the interest rate in the economy so that resources can be best used to produce best economic growth possible. So in order to know what should be the interest rate, we need to know what is the economy at present. So what is the economy at present is nothing but a measure of national income. So with the national income, the RBI can plan what should be the inflation or what should be the targeting of inflation and what should be the interest rates so that the inflation target is met, and if the interest rates are so and so, what will be the economic growth rate. Similarly, government can plan financial planning also. Fiscal planning by government simply means what should be the taxation, what should be non-tax revenues, and how to raise money. We should note that monetary planning in India falls mainly under RBI's purview. However, fiscal planning falls under Government of India's purview. Measuring national income also helps us understand or evaluate the impact of government's policies. For example, every year, many government's programs as well as schemes are released. If you want to evaluate whether the scheme or program is in effect working on the ground or not, you need to measure national income and see what is the growth and what is the benefit of that program and scheme. So national income measurement also helps in evaluating the impact of government's policies. Also, it aids in evaluating the nature of economic growth, whether that growth is sustainable or not, and whether that growth is causing higher inflation or is it decreasing inflation, whether such kind of growth is actually benefiting only some people or all the people, is it causing inclusive growth or not. All these aspects can be studied once we measure the national income only. Also, evaluating and measuring national income is important for long-term policies of a government, because long-term policies are made for sustainable growth. It also helps in raising investments, that is the capital. It also helps external investors in their decision making. For example, if we are measuring national income every year and we are plotting the economic growth curve also, an investor from outside may choose from 2 or 3 countries which has the best growth potential for his investment. Only then he will be investing in the economy. For example, in India, if the growth rate is consistently high, we have been receiving foreign direct investments consistently. This is one of the most important factors for India receiving FDI. At the global level, it also helps in comparison of countries. Why is comparison of countries needed? Because most of the agencies like IMF and World Bank give aid to different countries based on the national income or per capita national income of the country. Even most of the agreements which are done between countries at the world stage also need comparisons of countries so that different targets can be set to different countries. For example, if you are going to control pollution or if you are going to tackle climate change, you should not put less developed countries or low income countries at par with high income countries, because low income countries are mostly at developing stage itself. However, high income countries have higher incomes so that they can invest in better technologies to prevent climate change or to reduce the pollution. Similarly, if we look at World Trade Organization also, World Trade Organization also has certain provisions for low income countries. Let's look at the national income measurement. National income is measured using 3 methods. The first method is called as production method. The second method is called as income method. And the third method is called as expenditure method. That is why the definitions of national income differ. We have seen in the previous slides, the first definition was related to the income and the second definition was related to the production of goods and services. Similarly, we can make a definition based on the expenditure also. So depending on the type or the method used, we have different measures for national income. So GDP is a national income if we measure it using a production method. Similarly, NDP is also a national income which is measured using production method. Using income method, we can measure national income in the form of GNI and NNI, GNDI and NNDI, GDIH, GDIG and others. We will learn more about this in the coming videos. Also, using the expenditure method, which is also called as consumption method, we can make or we can measure national income in these ways: funds flow approach and commodity flow approach. Before understanding why there are different methods and whether all these methods give same result or not, we have to understand how income flows in an economy. Income mainly flows in an economy between 4 entities. They are individuals, also called as households, investors, also called as firms and businesses, and then there is government and foreign nationals. Foreign nationals are external to the country, but these 3 entities, that is individuals, investors and government, are present in all countries and all economies. Just for the sake of simplicity, Let's consider only two entities to understand the income flow, that is individuals and investors. Let's put individuals and investors on both sides and try to understand what is the relationship between them. Individuals supply investors with labor. That is, individuals work for a company or a firm, and such kind of contribution is called as labor. And for their contribution, they receive wages. Individuals and households also give land to the investors and firms. Owner or investor himself is actually an individual. So, the firm owner is an individual. Suppose he is using his own land to establish a firm. He is an individual who is supplying land to the firm. They are considered as two separate entities in this manner. So, when individuals supply land to the investors or firms, they get rent in return. Similarly, individuals who have savings provide financial capital also. For their financial capital, which is given to the firms or investors, they get interest in return. Individuals also supply entrepreneurship or enterprise, their knowledge and skills through which they operate firms. For the entrepreneurship or enterprise they supply, individuals get profit in return from investors or firms. So, if you look here, individuals are supplying labor, land, capital and entrepreneurship to the investors, and in return, investors are giving wages, rent, interest and profits to the individuals. On the other side, now individuals have supplied all these and have got these. All these form income part. Okay, all these form income part. Now, with the labor, land, capital and entrepreneurship which is provided to the investors or firms from the individuals, firms will produce goods and services. These goods and services are supplied to individuals again. This is called as products. For the products which are supplied by the investors or firms to the individuals pay with their consumption expenditure to the investors. So individuals pay money to get the goods and services. Such money is called as consumption expenditure. So we have three aspects right here. One is income, which is obtained from investors to the individuals. One is expenditure, which is given by the individuals to the firms in lieu of the goods and services, that is products which are supplied by the firms to the individuals. So this circular flow is how relationship exists between individuals and investors. To this simple circular flow diagram, we can also add government and foreign nationals. Government and individuals and investors are mainly related through taxation. Taxation can be on the production process, or they can be on the final products in the form of GST or other indirect taxes. Now let's look at what is value added. Value added or value addition is nothing but output value minus input value of the goods and services. So whenever a production take place or production process take place, we know that resources are converted into useful products. So the difference in value between the useful products and resources is nothing but value added. These useful products may be final products which are consumed by the consumers, or they may be intermediate products which are further processed by a different industry into useful products. Again, these useful products may be final products which may be used directly by the end users, that is people like you and us, or they are used by again some other companies to produce further products. So value addition represents the change in the value, that is output value minus input value of the production process itself. What is gross value added then? Gross simply means total in economics. So wherever the word gross is, we can understand that it means total. So gross value added or total value added is nothing but the value addition within an entire industry or within an entire sector or even within an entire economy. So value added is for particular object or particular product or service, but gross value added is for an entire industry or entire sector or entire economy. So that is why it is called as total or gross. GVA or gross value added can be calculated at different prices and costs. For example, factor costs, basic prices and market prices. Gross value added is often defined like this: output minus intermediate consumption. For example, consider this relation where some useful products are converted into other useful products. These useful products are not directly used by the end user, that is people like you and me. So a firm or a company can convert these products which are intermediate consumption products. So intermediate consumption products are nothing but those products which are not useful products and are consumed by the firm to produce an output. The difference between this output and the intermediate consumption is nothing but the gross value added. Let's follow up in the next video. Please like and share this video. Also subscribe to IAS Project. Thank you.